to the morning sun. I feel you touch me in the pouring rain. In the moment that you wander far from me, I wanna feel you in my arms again.
Hello and welcome back once again to the Short Vol Show, special Saturday edition, as we check out some option setups. And let's see what we've got going on here. I was looking at some of the earnings coming up this week, and indeed I think we're kind of wrapping it up as far as earnings go, with some major ones this week coming out Monday, Tuesday, Wednesday, actually the whole week. And I did have a list on StockTwits of all the earnings. Let's see if I can find it again. One of them that kind of caught my eye was the Paycom. Now, I use Paycom at work for here's a list of some of the earnings. Let me get my mug out of the way here. I use Paycom to punch in and out of my my side job, and I just saw it on the list. It's on Tuesday, so I figured I would check out the stock, which I've never looked at before. Symbol PAYC, and what I notice is that it looks kind of toppy, huh? Now that doesn't mean it couldn't rip higher, of course, but many people might want to try a bearish play on this for earnings Tuesday. So how would you do that with options, and which options would you pick? Well, I would look at either some sort of a put vertical, maybe. So August has 20 days to go. Now, when you're dealing with a put vertical, you don't have to worry as much about volatility crushing. When we come into earnings, usually what happens with the options is the day after earnings, it either makes a move or doesn't, and then options usually volatility comes in, option prices go down because the big event is over. And so if you are going to buy options, you want to be aware that their prices are going to go dramatically lower after earnings. So to kind of offset that, if you're buying one option and selling another, then that kind of takes that vol crushage out of the equation. So I was looking at maybe some put verticals. Now, stock's $108 right now. So if you think it was going to go lower, well, let's take a look. Where do you think it could go to? It could go to maybe 100. It could go to 95. It could do nothing. But let's say that in your mind you're thinking that, wow, this could go to 100. I want to capitalize if it's going to go to 100. So what could you possibly do? Well, maybe you could do like the 110, 100 put vertical. So if we look at some of the option strikes. Okay, so behind me is, it's funny how my microphone just kind of goes out into thin air there because of the green screen. Let me move out of the way here, though, so we can see this just a little bit better. Okay, so here's the option screen and I'm going to switch the view. If you go up to the top here in Thinkorswim, you can switch the view to something different. I have this preset called Dave 1 that has the bid, ask, and the bid and ask size. Is that what I want? I'm not sure if that's what I want. Let's just keep it simple here. Bid, ask, volume, and open interest. All right, so just so we can see. So down the middle here are is the expiration date, which is 17 August 2018, and then the option strikes. Okay, so if we're looking at a put spread where we're buying the 110 put, we could go down here to the 110 put, and we could click on the offer to buy one of those puts. Okay, it's going to bring up our order entry screen here, and indeed it says buying one, Paycom August 110 put for $6. Okay, let's minimize that, and then I'm going to go to the put I want to sell, the 100 put, and I'm going to hold down the control key, and then I'm going to click on the bid for that put since we're selling that one. Okay, so then we've got our trade together. So we're buying the 110 I'm sorry. We're buying the 110 put and we're selling the 100 put. It's a $10 vertical. So $10 between the strikes. We're paying $3.95. So let's say we're paying $4. So we're paying $4 for a $10 vertical. That means that, let's bring the chart up again here. So that means that first of all, if we're paying $4, the break-even point would be $4 lower than the 110 strike. So 110 minus 4 would be 106. Right now we're already at 108. So we need it to move down $2 to break even. Well, that seems pretty reasonable. For our maximum win, we need it to go to 100 or below by expiration, which expiration, as we said before, is on the 17th of August. So that's like 2.5 weeks away. Now, like I said, we're paying $4 for a $10 put vertical. That means that we're betting $4 to make 6. So we would more than not double our money. We'd make 150% of our money. So so it would be decent payout if we could get if it would go to 100. The thing is that we just don't know what's going to happen on earnings. So we want to see what our risk is. Well, our risk is here that we're paying $400 for each one of these. So if the stock just hangs out at 110, this is going to decay, and we could end up losing $400 on each one. So it's a bit of a risk here. How could we do something that's a little less risky? Well, we could buy a different spread, for example. We could buy the 105 100 put spread, and that way it has to go down a little bit further for it to be in the money, but you're putting up less money. So let's click on the 105 put on the offer, and then hold down the control button and click on the bid of the 100 put. So now we're paying $1.55 to win $3.45. So once again, on this one, you could potentially double your money. And you're risking a little bit less per each one, $155 each time. So that seems maybe a little bit better in that you've got less. You're outlaying a little bit less cash. I mean, you need like a little bit farther removed, because this one, to break even, you need this to go to the 105 strike plus the premium. So you need it to go to 103.45 to break even. So that's down $5 and change to break even on that one on the move. But you aren't outlaying as much cash. So and the added thing with this is that if you were to put this on Monday, you've got a day of movement before earnings too to figure out what you want to do. And if it goes, if this gets back up to like 115, you could put on more. If it goes your way, you could take it off for a profit. Something to think about. The other thing, if you are thinking that this is definitely going to go lower, you could sell an out-of-the-money call spread. So you could sell something like the 115, 120 call spread, or how about this, the 115, 125 call spread. So you could sell the 115 call, and then you could buy the 125 call for $1.65. So as long as this stays below 115, you're going to collect the $165 each time you do this. So that's another way of, and in this particular selling a call and out of the money call spread, the added like benefit of that is that you don't need this to move anywhere for you to be in the money. As long as it stays where it is and doesn't go too much higher, then you're in the money. However, with that spread, you are risking, essentially without the money call spread, you're risking a lot to make a little. So if it's a $10 call spread and you're selling it for $100 and something, then you're gonna have a little bit more risk to lose money if it actually does spike to the upside. So it's a higher probability trade of you being right, but if you're wrong, you're risking more money in a way. You see what I mean? Because it's a $10 vertical. So if, let's just say it was $150, well, you collect $150 if you're right, but if you're totally wrong, you're gonna lose $850 because the difference between the strikes is $10. So if you say $10 minus, let's say it was $150, $10 minus $150 is $850. So each time you do that, you're risking losing $850. Now, the way that margin requirements work, you have to have that money in your account and it's put aside for you, and you're not allowed to use it for any other sort of trading when you put that spread on. So it's a situation where you have to already have that money in your account to be able to risk it. So it's not a situation where you could get a call, a tap on your back, and your account goes negative. It's not like selling a naked option. It's a defined risk trade, and you have to have that cash in your account to take the trade. Now, the other aspect of that is that if you do decide to take this trade, it's locking up capital for a little while that you maybe would have wanted to use for something else. Maybe there was a wiser thing you wanted to do with that capital. But I kind of like the idea of putting on a higher probability trade like this one, and it's going to come in more times than not, as opposed to the one where you're betting that this is going to go definitely to 100, and if it doesn't go there, you lose $400. I kind of like the idea of, well, if it stays kind of where it is, I'm going to collect money, and only if it makes a big spike up will I lose it. I kind of like selling the call spread more than buying the put spread on, and there's many other trades we could do here. We could sell a strangle maybe, or we could sell the 110 straddle. Let's just look for curiosity at what price the 110 straddle is. Now, there's a thing you can do with this setup in Thinkorswim. I can go to the top of this page, and where it says spread here, single, I can click on that, and I can go down to straddle here. Now it's going to show all the straddles, bids and offers. And once again, I'm in the way. So let me move over here for a second. So if we look at the 110 straddle here, it's trading around $10. And indeed, if you look up to the top here where it shows this little signal here and says 7.7, that's sort of like the expected move. So 7.7, that's like the average daily move. So $10 straddle. Let's take a look at this chart again. Does it seem reasonable? The straddle's worth $10. That would give us a range anywhere up or down of $10 to break even. And that seems reasonable. Maybe you sell just a couple of these straddles. Now remember, selling a straddle is selling one naked call, so you do have risk if this just rip to the upside. You do have unlimited risk. To the downside, your risk is that it goes to zero, so that's not unlimited, but it's a long way to zero also on this one. But assuming that it doesn't make some huge move, let's look at these earnings here. There is a little gap this last earnings, but assuming it doesn't make a huge move, the straddle for $10 seems reasonable to me. So you might think of selling that straddle. Now, what you could do is you could sell the straddle and buy some wings on the outside, turning it into a butterfly. or you could just sell the straddle, and if you're worried about only worried really about the upside, then you could sell the straddle and buy a way out of the money call also. So if I switch the spread back to single, and things look normal again. You know, you could buy a way out of the money call, like a 135 call for, you could probably get it for 5 cents, something like that, just to protect you, you know, give you peace of mind when you go to sleep at night, and then sell that straddle for $10. So all kinds of things you could do in this Paycom earnings. And let's take a look at a couple other earnings that are due to come out around that time. Let me kind of straighten myself out here. Okay, so let's go back to StockTwits here and see if there's we have had a couple kind of nasty things with you know, Facebook down, Twitter was down pretty big. Let's take a look at Twitter for a second. Trading 34, but we did get the gap down $10 on that. Now that's a pretty big move. Twitter's probably not going to stay at 34. Look at that chart. That's pretty wild, huh? And let's take a look at option volatility. I'm going to switch my chart back to implied vol. Or we can go to analyze here, and we can look at these stats. Okay, so current percentile, 37th percentile. Current historical vol percentile, 100. That's because of the rip. So options volatility has come in after earnings. So there might be some opportunities here to on the long side with options, either by just outright buying a call or a put, or buying a vertical. And I think some people will play this to the upside, thinking that it's going to go back to where it was, and you could buy with 20 days to go. Everything looks cheap there, doesn't it? It's just because it made a big $10 move just a couple days ago. The straddle right now, if we go back to this, I have an easy way to look at straddles. $3. Okay, so if you were long straddles with that $10 move, you cleaned up. So a straddle $3 now. Now this could continue on the move. You know, they want, you know, as a market maker, when earnings comes out and it's made a move, you want to, especially if you're short, you want to bring volatility in quick so that when people come to sell the stuff back to you, it's at a decent price. But let me switch this back to single options, and you know, everything looks cheap here, doesn't it? You could see this going to 37 again. 59 cents for the 37 calls looks cheap, but certainly you could buy a vertical. You could buy there's only 20 days left in August, but you could buy something like the August 36 call, and you could sell the 39.5 against it. So you've got a $3.50 vertical for 60 cents. I like that. Maybe we should do something that makes the math easier. So we're buying the 36, and we're selling the 41 call. Oops, sorry, I didn't start afresh. So we're buying the 36, and we're selling the 41 call. So $5 vertical for 69 cents. So, you know, if you play for a little bounce here, it seems reasonable that this could bounce back through 36 again. I mean, it just gapped through there. So that seems like a nice vertical, the 36.41 vertical in Twitter. If you're playing at the upside. Now, some people might think, well, it hasn't stopped falling yet. So, you know, when stuff is really cheap, it just looks cheap to me, all this stuff. The volatility right now, it's showing implied volatility in the 50s. I'm sorry, at the money in like 45, something like that. Let's look at, but you know, this front, I mean, it could be cool to play, you know, this front week stuff, because we could get moves next week. So even just, I mean, look at this. Look at the 35 and a half calls, 46 cents. They seem cheap to me. If you're playing to the downside, the 33 puts, 51 cents. You could buy this and sell the... See, I wouldn't really want to sell... I don't think I would want to sell something against this if I bought one of these puts. I mean, you could do, I guess, a $2 vertical, but I'd almost just want to buy the puts, wait, and then look to sell something if I was correct on the move. But this all looks really cheap to me here. All right, let's go to Tesla. So my spreads didn't do so well this week in Tesla because they kind of moved away from the strikes. I would love for it to go back to 325 here. I have to decide by Wednesday if I want to get out of my positions or just stay in it. Right now, I'm leaning towards getting out and then just reestablishing after earnings. And the reason I'm saying that is because I think volatility could really come in, and my positions are pretty long Vega. Right now, we're at the 88th percentile in implied volatility, and I could easily see that go back to the 50th percentile. It's showing volatility here, 77%. And like I said, my Vega, of course, comes from September, and September isn't as high as 77% at all. And I know that the stuff that I'm short is going to get crushed, but the question is, does September get crushed more since the Vega comes from September? There's a lot more volatility related. There's a lot more Vega on farther out options, as we know. So we got to think about it a little bit. If we look at the volatility of September here, like the 300 strike, these strikes, it's a 54. So the question is, does that go down to a 30 or something? I would hope not, but it definitely could, because it's saying historical volatility, like this thing's moving around at like a 37 and the options are at 88. So options are a lot higher right now than the actual moves it's making. So it could get, that means it could make a big move, A, but B, there's a lot of room for them to crush volatility, and I'm long a decent amount of Vega due to my spread. So it might be prudent for me to take off the spread before Wednesday afternoon, and I'm just going to keep monitoring that up until that time. So anyway, I hope some of this stuff is interesting to you. If you have a stock that you are looking at that you might want to want me to talk about, or maybe you could come on and talk about it yourself. To my spread, so let me know. Anyway, thanks for watching, guys, and I will see you again on Monday morning. And until then, yeah, check out some of this stuff. Come up with some ideas for this week, because there's money to be made out there, and I want you to make money. Thanks for watching.
To me on a summer breeze, keep me warm in your love, and then softly leave. And it's me you need to show. How deep is your love?